Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning guest to the program today, Michael Pento. Michael is the president and founder of Pento Portfolio Strategies and is a specialist in all things U.S. economy-related, inflation, GDP, unemployment, you name it. Michael, thanks for joining us again.
Thanks for having me back on and for that nice introduction.
Absolutely. Well, in your latest weekly email, you wrote, "Prepare now before the real crash begins." I think that's a great place to start. What do you mean by that? Have we seen anywhere close to the worst of it yet?
So, this is a crisis that we're seeing today, a crisis caused by the Wuhan virus. We all know that. But the question is this the Greater Depression? I like to say the Greater Depression. Forget about the real crash. We'll call it the Greater Depression, which I wrote about years and years ago. And I wrote a book in 2012, published in 2013, saying the coming bond market collapse. It's called the coming bond market collapse. And I never thought back then that it would take so many years. Here we are, 8 years later, 7, 8 years later. The bond market didn't really collapse yet. And as a matter of fact, we now have $17 trillion of negative yielding sovereign debt in the world. When I wrote the book, the vision I had was the Greater Depression, which is the actual verified crash, the real crisis that's coming, is the insolvency and inflationary implosion of the bond market. That's what I envisioned in 2012. But I never thought that we would see negative yielding debt on the sovereign level, and I sure as heck never possibly imagined or dreamed that we could have negative yielding junk bonds. But that's the yield for about $500 billion in Europe, and it's growing, by the way. So what we have here, what we have created, which is what I call the Greater Depression, is going to be an inflationary insolvency collapse of the global bond market. It's not going to be a collapse of the U.S. dollar. It's going to be a collapse of sovereign debt and all fixed income globally. And think about it. Coming into this crisis, let's just take the United States. We had $71 trillion worth of debt, 330% of GDP, Colin. And now, because of the crisis, because of the Wuhan virus, we've dramatically added to the numerator on that debt. Dramatically. I mean, look, we just passed another $500 billion. Or it went through the Senate. It's going to be passed by the House, but it'll be signed and passed by the House and signed into law. A secondary stimulus package. So, we're talking about adding to the national deficit, close to $4.5 trillion, somewhere around that range. $4.5 trillion annual deficit for fiscal 2020, which ends in October. And we had $71 trillion coming into this Wuhan virus crisis. We're dramatically adding to that amount of debt to the tune of trillions of dollars this year alone, in 1 year, just as the denominator is being attenuated. You could have estimates of 10, 15, you pick the number. It's very hard to see and to tell and forecast exactly what the drop in GDP is, but the denominator is dropping. So here's the only missing piece now. So you've vastly increased the amount of debt. You're eviscerating the denominator, and central banks are monetizing all this debt. So the Fed is printing money by the trillions. And eventually you're going to get inflation, I think, not like you had in 2008, which was just sequestered on Wall Street. You're going to have inflation in consumer prices because we are directly sending money to people and corporations. We're not just sending money to banks so they can gamble on Wall Street. So if you have inflation, insolvency, destroy the bond market, if that's the case, what is a government going to do? That means that a government is going to say, I can do one of two things. The bond market is cratering in price. Yields are soaring. I can either increase the rate of inflation, so then you increase the inflation part of the bond market debacle. Or I could stop printing money, but I've been the only buyer. Let's look at Japan. The Bank of Japan is the only buyer of Japanese government bonds with a negative yield, with a quadrillion yen in debt outstanding. So the only buyer is going to step away from a negative yielding bond, then yields are going to soar, prices are going to crater. That is the genuine crisis. That is the crisis of an inflationary and insolvency implosion of the global bond market, which will lead to the Greater Depression, I'm afraid.
Michael, there was a $450 billion stimulus bill written about yesterday, which I'm sure you saw, and I posted the article from Bloomberg to my Twitter because I couldn't get over the title. And it wasn't just Bloomberg that did this. They called it explicitly an interim stimulus bill. Shocking to me that $450 billion, which was a huge number in 2008, is now being referred to as interim.
Well, first of all, Colin, we just talked about it's 480. It's almost a $500 billion. It's 483. I think the number is 483 exactly. So, but that's not enough for half of D.C. So the Democrats and Republicans, they both love to spend money. But Pelosi, right, Speaker of House, says, well, this doesn't address state and local governments, right? Because they're definitely insolvent, right? Think about the pension crisis. You know, if you're a state and local government, you're paying out claims for unemployment, and you're collecting no tax revenue. There's no revenue coming in. So these insolvent pension plans and insolvent governments are even more upside down. And if you're a Republican, if you're Donald Trump, you want to spend more money on infrastructure. We're going to rebuild every bridge and repave every road in the country. So it's not just it's interim. It's not just like we had this one iteration of a bailout. The bailout now, like I said, is $4.5 trillion. It's $8 trillion worth globally, and all of it's being monetized and then some by central banks. What could possibly go wrong with that philosophy?
Michael, I've read stories about the Great Depression, and I guess one way that it's been described is it affects a lot of people in a really bad way. In fact, probably most people, but then some people don't really get affected at all. And you look right now, it's shocking to a lot of people that the Dow and the S&P are holding up quite well. And yet a lot of people are suffering to the point where they need help on buying groceries. Do you not think that's going to drive a huge amount of tension between those who have and those who don't?
Well, there's a beautiful question, Colin. Congratulations to you. I mean, we've been wiping out the middle class for years now, especially since the aftermath of the Great Recession. You know, what happened in the Great Recession? Well, people couldn't pay their mortgages. So did we send checks to people to pay their mortgages? No. We took the bad mortgages and loans that are on banks, took them off banks' balance sheets and parked them at the Federal Reserve. So that bailed out who? It bailed out banks. It didn't bail out the person still lost their house, but they weren't paying the Federal Reserve. Not that they weren't paying banks, they weren't paying the Federal Reserve, right? So now we see coming out of the Wuhan crisis, we see a further evisceration of the middle class. Only this time, we're still bailing out banks, but now we're trying to sort of, tink around the edges of bailing out people, sending checks to people, like through the CARES Act and enhanced unemployment, paying small businesses not to fire people, and then paying those same people that weren't laid off $1,200 and sending them $1,200 in the mail, plus $600 per child. So, here's the thing. It used to be the fact that earnings and the economy drove Wall Street. Colin, that's when we lived in reality. We live in a fantasy world now. I mean, reality has been destroyed. Now it is, let me see. We learned today, by the way, this is the recording of this interview Thursday afternoon. We now have lost 26.5 million jobs in 5 weeks. The April Market Composite Purchasing Managers Index, the Flash Index, was 27.4, where 50 is the dividing line between a growth and a recession. So if 49.9 is a recession, we have 27.4. That's depression. We have now wiped out every single job created since the Great Recession ended in June of 2009. And the stock market is down what? Maybe it's like 50, 30, no, after today, maybe down 13, a little more than 10%. The S&P down 10%, or a little bit more than that for the year. And why is that? There's only one answer to that question, is because, like I said, we are no longer living in reality. This is a fantasy created by massive monetization of debt from central banks. And the central banks of the world are not only just buying sovereign debt any longer, they're buying corporate bonds, junk bonds, in some cases stocks, and Fed is actually making loans in the primary market to businesses. So when I say in some cases, the Fed is not buying stocks yet, but the Bank of Japan is. That's the reason why. And you see, and you asked the question perfectly, Colin, what happens when you make the richest among us more wealthy, because we own so much of our wealth percentage-wise is in bonds and stocks and real estate? Well, we benefit, right? But the person who's on a food line, who hasn't yet received their unemployment check and doesn't have a lot of stocks, they don't have any probably, and they're renting a home. And that's the trenchant, yawning, widening gap and evisceration of the middle class and the gap between the very rich and the very poor. Not good.
Yeah, that's great. And I want to touch on something you brought up in an answer ago, inflation. In the strictest sense, inflation is simply an increase in the supply of money. But in reality, as we've learned, inflation versus deflation is not so easy to understand. And then there are words like stagflation and disinflation, really confusing stuff. But you said something important. You said this time the inflation is going to be real. It's going to hit on the consumer price level. Explain that to us.
Well, it's very simple. So inflation is not an increase in the money supply, because you have to define what the money supply is. I mean, that's what Milton Friedman said. It's a monetary phenomenon. He's sort of correct. I agree with him. But we increase the Fed's balance sheet. We, the central bank of the United States, increases the Fed's balance sheet from $800 billion at the end of 2008 to $4.5 trillion by 2015. That's a lot of increase in money supply. But what kind of money supply? It was base money. It was Fed credit. And as I said before, that credit just was running around the canyons of Wall Street, circulated around there. It was sequestered in banks, held at the central bank, and they gambled on stocks and real estate. So it didn't really reach the average Joe. But this is different. This time around, we are sending checks, we are using helicopter money, a form of UBI, Universal Basic Income. We started down that road. And Washington, D.C. wants more of it. So instead of just bailing out Wall Street, which increases the money supply of Fed credit, which enables banks to lend money out, but banks didn't lend money out. If they don't lend money out to consumers and businesses, the broader monetary aggregates don't grow and you don't get massive inflation. But if you circumvent the banking system and send people checks in their mailbox, that increases directly the broader monetary aggregates. In fact, it increases money supply across the board, not just Fed credit, which means you're increasing inflation, but you haven't yet solved the underlying problem of massive debt outstanding that has to be lugged around. You haven't really reinvigorated the economy because supply lines are cut and there's disturbances all over the planet. So what you might see, and all depends upon how far D.C. takes it, and not only D.C., but it's Japan, it's Europe, it's China, it's all around the globe. How many times and to what degree do central banks continue down this path of UBI and helicopter money? The more they do, the higher the rate of inflation and stagflation will become. And the less they do, the more we'll see deflation and disinflation. I'm inclined to believe that the inexorable trend towards some kind of regular stipend that is given to people who are fallow and not working is here, and it's going to stay.
Well, thank you for that explanation. This all leads me to a question on the yellow metal, gold. I assume that gold is one of the ways that you think people can not just protect but enhance their situation during times like this. Can you talk to us about what you're looking for gold to move and if it's all in place? Well,
so when I think about, and by the way, I'm not always in gold. I love gold. It's a great place to park some of your money all the time. 5% should be a base of gold. But when do you want to increase that? Right now, my portfolio, the inflation, deflation, and economic cycle portfolio model and strategy, so I manage money here at Pentoport, is 20%, which is very close to the max. 25% is the max we would ever be in one particular category. You don't really want to go over that because then you're overexposed. And I'm most considerate of principal preservation here. But when would you want to own 20 or 25% into AU? Okay? Think about this. So gold is money, and it always competes with physical cash, the yield you can get with physical cash that's deposited in the bank or short-term money market fund. It's not an investment. Gold miners are an investment, but gold is a placeholder of your wealth. It guarantees that you won't lose purchasing power. Well, when would you want to put a lot of money into gold? Think about a scenario. Scenario is, well, let's see, a global economy crashes, central banks come and they monetize trillions of dollars of debt, repressing interest rates down close to zero and below around the world. So nominal rates, the nominal rate you receive on cash is close to zero, and that's never been the case before globally, but it is the case today. And this is important, central banks are very busy trying to boost the rate of inflation to 2% and above. Well, that sort of guarantees that the cash that gold is competing against offers a negative 2% the way they measure it, but in reality, it's probably not going to be just 2% inflation. It'll probably be 5, 6, 7, 8, 10, low double-digit inflation, subtracted from zero, which means real interest rates are plunging. And they will continue to do so, in my opinion. Well, that is the absolute best environment that you can possibly ask for to see gold increase its value. And that is what we have today.
Michael, you've been very gracious with your time. I know you do have other appointments to get to. I'd like you, if you don't mind, to share your website and any other contact details for listeners interested in getting in touch.
So the website here is Pentoport, Port.com. And my email address is mpento@pentoport.com. You can call the office here at 732-772-9500. And if you have around $100,000 to invest, we'll put you in the IDEC model, the inflation, deflation, and economic cycle model. If you don't quite meet that, you can always subscribe to my podcast called the Midweek Reality Check, where you'll get every Wednesday in your inbox my analysis and some broad general feelings on where the economy and markets are headed.
Excellent. Thank you so much for coming back on the program today, Michael.
God bless and stay safe.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?